Welcome to another quarterly market update. I'm Rob Currie. I work with the investment team across our mandates, but more specifically on global equities. We're going to review returns for different asset classes, the current backdrop for investments, and our positioning for the future. Let's dive in. A few times in these quarterly updates, we've highlighted that the income generated by fixed income assets should translate into positive returns now that yields have rebased higher. Positive returns are now starting to reflect a more stable interest rate environment where the up and down moves in interest rates or yields can be absorbed or amplified by the income the asset generates. We'll talk more about this throughout the presentation. Turning to the equity side, the U.S. continues to outperform other geographies dramatically, but this has really been driven by a handful of very successful stocks, and we'll go through how to think about that and what it means for investors throughout the presentation. Starting with fixed income, the Canada sovereign yield curve is what we're looking at right now. This is a key indicator for fixed income investor expectations for interest rates and inflation. Rates peaked last October and have since come down. So as we'll see in the preceding slide, comparing today's yield curve to the end of last year, short-term rates have fallen while long-term rates have risen. However, in the quarter, yields declined overall. Instead of looking at the curve, this slide shows one point of the curve, the 10-year, but over time. As I stated a moment ago, rates have come down since last quarter, but are still higher than at the end of last year, 2023. These fluctuations underscore the shifting economic expectations around the economy and inflation. One of the things I like to highlight is the spread between the U.S. and Canada, where if we look at the 10-year yield, the spread, it's contracted a little bit from 90 basis points last quarter to 80 basis points, let's call it now. But that spread is still quite important. It's one of the things that drives the exchange rate that we're seeing right now, and again, highlighting kind of different interest rate expectations over time. If we look now at expectations for rate cuts, we started the year expecting 6 rate cuts in the U.S. and 5 in Canada. See that there? Now, if we look at last quarter, kind of when I had taken this data at the end of last quarter, a couple of weeks after last quarter, it fell dramatically to about 1.5 rate cuts in the U.S. and then 2.5 in Canada. But now, if you look at today, we're looking at 3 cuts in the U.S. and just over 2.5 in Canada. I know I've been a bit redundant here, but these 3 past sections have all looked at the same point from a different lens, which is that interest rates have been volatile but are still trending down, which is positive for fixed income returns. Interest rates they're significantly influenced by the rate of inflation, so let's spend a minute looking over the current drivers of inflation. Core goods prices, they're now falling. Most retailers have begun discounting and releasing inventory now that supply chains are back to normal for most industries. This is putting pressure on prices. Housing services price growth is slowing, though it's still contributing to inflation more than in the past. We'll dive deeper into this in the next slide. Lastly, core services X housing. This is still quite sticky. The labor market is finding a better balance, but it's still quite tight. We've seen a small uptick in unemployment so far this year in the U.S. from 3.7% to 4.1% in June. The Fed's long rate sustainable growth rate, just as context to this, the long run and sustainable level of unemployment is 4.2%. This is also similar to the CBO that puts that at the natural rate of unemployment. So we should start to see wage pressure soften. Hourly wage growth, again, to add more context, it's about 4% in the U.S. Now, one of the large drivers of inflation right now is services, in particular housing services. The Federal Reserve in the U.S. uses PCE instead of CPI, so that's where we'll go for our analysis here. What they show with this chart is that real-time inflation in rent usually lags. If you look at kind of other housing indicators or rent indicators from private data providers. So actual inflation peaked in, it's called 2022 for these measures, where reported inflation peaked in 2023. So now what we're seeing is many of these measures in real time for real-time housing services inflation are below the reported numbers that are in the inflation number itself, implying that future numbers will be lower still. I could show a lot of charts that add some credibility to this idea and some that remove credibility from the idea, but in general, the market feels pretty good about inflation trending in the right direction. Now, one of the things I like to look at too when we're talking about how the market's viewing risk and where we are in the cycle is what high yield spreads are doing. These are a good indicator for how fixed income investors are viewing corporate credit risk, and it remains quite low. Another way to say this is that there are times when the market is offering much higher return for higher risk. Today, the additional return for risk is more muted. Now, our positioning in fixed income, despite credit spreads being tight, as I showed in the previous slide, we still are finding good value in short-term Canadian credit, specifically high-quality investment-grade bonds. Because of this, we are overweight corporate bonds, which are paying us added yield over the Government of Canada bonds, We're overweight by about 8% in our Lewisburg Canadian Bond Fund. We're also positioned with slightly less duration, with 7 years versus the benchmark at 7.2. Switching gears to equities, the bifurcation between markets has continued to exacerbate, and when we examine equity market valuations, we find the S&P 500 notably more expensive than its counterparts. I keep coming back to this chart in various presentations that I give because pundits try to use it just to tell a story about where you should invest or where we are in the cycle. In reality, the U.S. has more exposure to technology and companies with artificial intelligence tailwinds. If we were to examine the valuations of similar companies in each region, the difference would be a lot less. What is true and important to acknowledge is that the top 10 companies in the S&P 500 by market cap are creating a lot more concentration in the index than we've seen in the past. This means a large portion of returns in the future for the S&P 500 will be driven by the top 10 stocks. Here's a chart that highlights what I just spoke about. The equal weighted S&P 500 is up about 15% in Canadian dollars over the past year, whereas the S&P 500, which is weighted by market cap, is up almost 30% Canadian dollars. This is even more true when we think about the year-to-date performance. During the second half of 2023, thinking of last year, both indices performed similarly. There's a few differences, but in generally the same. It has really been a 2024 phenomenon where we've seen a handful of outperforming stocks, and so the breadth has been very low. It's important to point out that we at Lewisburg have made significant moves in the U.S. portfolio so far this year and do not have this same concentration. What this means is that our returns and the S&P 500 returns are likely to look very different over the next 12 months, for better or for worse. Lastly, here's another look of what I was saying with the S&P 500 top 10 concentration over time. It's going from, let's call it 20% or just under 20% at the end of 2010. We fast forward to today, and it's over 35%. So it's a significant increase in concentration of those top 10 names. To summarize our positioning, we're finding many attractive opportunities. And specifically in the Canadian Dividend Fund, we find a lot of attractive priced companies that involve commodities. We're overweight the materials sector. We're well diversified across base metals and precious metals, agriculture, other materials. We're also benchmark weight the energy sector, but we're focusing all of our capital on high quality producers as opposed to infrastructure companies, etc. The cash flows from our businesses that we own in that industry, they're able to just take those cash flows, pay down debt, and give the rest to shareholders. So we feel very comfortable with that. If we look at consumer staples, consumer discretionary, healthcare, technology, real estate, those are also sectors that we're finding attractive risk-reward propositions, which explains our above benchmark exposure. On the other side of the spectrum, we're below benchmark in financials, given our moderate position in banks. We're also underweight industrials, as we're currently light on railway, which is a pretty significant portion of that sector in the Canadian market. And we're approximately market weight in communications and utilities. In the U.S., we've begun to look even less like the benchmark, as I noted. As investor risk appetite grows, we remain disciplined and have been rotating towards out-of-favor defensive sectors where we see much better risk-reward propositions. We continue to hold a healthy relative weight in consumer staples, healthcare, and utilities. We remain underweight in the IT sector, given what we perceive as demanding valuations. We instead prefer the communications sector with exposure to digital advertisers and media companies, where valuations look more compelling. Finally, we remain underweight consumer discretionary, as we're struggling to find companies that we find are at fair prices. So lastly, looking at our international equities, we continue to hold a healthy weight in consumer staples, healthcare, and utilities, very similar to the U.S. fund, where we've had to rotate out of names that we find have had quite a run-up. So we remain overweight the IT sector, but we've taken some profit from the sector as valuations now look more fair. We remain underweight financials as we see less value in the banking sector overall, and they've had good performance in 2023. We're also underweight consumer discretionary, materials, and real estate. What about political risk? When it comes to political risk, there will be much speculation from pundits on which stocks will do better under which presidency or how the market will generally fare. Both outcomes have offsetting positives and negatives, in our opinion. With Trump, you might get tax cuts that are highly stimulative at a time where we're trying to cool the economy, and tariffs, which are inflationary for inputs. This could reignite the need for higher interest rates and create some noise, as businesses would surely benefit. Like I said, there's pros and cons, as inflation might be the offset. With Harris, you might get more government spending on social programs and infrastructure with less with less growth investment from businesses driven by less favorable business regulation and higher taxes, also creating noise. Ultimately, The president is supposed to implement regulation created by Congress. Therefore, we view large changes in the makeup of Congress as a more likely catalyst for diverging market behavior over a long period of time. There may be volatility 1 month. Really, there could be volatility as this election cycle goes on, but we're not assuming any significant change over the medium to long term. To conclude, looking at the future, we find the fixed income market here is quite attractive with higher expected returns from higher interest rates. Volatility could still be heightened given inflation remains above 2% in most developed countries. So we're kind of having still a little bit of a cautious outlook, but we still feel quite confident in the asset class. However, if inflation comes down more than we expect, we should have even better fixed income returns as interest rates should fall in tandem. Equities have had quite a run, but the breadth has been quite limited, highlighted by a few AI-driven stocks in the U.S., as I noted earlier. We continue to find companies with attractive valuations across our geographies and are therefore reluctant to assume that there'll be large pullbacks in the markets. We hope you enjoyed this market update and look forward to speaking more in the future.